covered so far the 13 bars, the concept of follow through with the 80-20. 8% of the time, these strong bars follow through. We've talked about how strong bars during the 20% of the time do get reversed with the 55%, okay? And the action that can be taken with that. We've talked about the fact that we want to trade in the direction of the daily bar of the market. The daily bar of the market dictates what type of daily bars in the stocks we're looking for. Once we get a collection of stocks with strong daily bars green or strong daily bars red, we go inside of those stocks and view the internal activity on the 5, the 2, the 1. We've talked very briefly about the fact that we trade with the daily bar and also with the moving averages on the micro time frames. I'm going to get to moving averages just now. And how do you fall in? How and when do you know when to strike? You strike when you get 55 and 100% retracement events on your micro time frames that are in sync with the daily bars. All right, now let's talk about the 3 trading moving averages. Okay, there are 3 dominant moving averages that I want you to have displayed on your charts at all times. These on your micro time frames in particular. These trading time frames are these trading moving averages are the 8-period simple moving average, the 20-period simple moving average, and the 200-period simple moving averages. Okay? Now, of the 8 and 20 are what I would call trending moving averages. All right? The 200-period moving average is not a trending moving average. The 8 and 20 are trending moving averages. Now, let's talk about the trending moving averages, the 8 and 20. Okay? The trending moving averages have several guidelines. Number 1, here are the several guidelines. I believe that if you want an easy life as a trader, an easier life as a trader, if you want to live a relatively trouble-free life as a trader with very few bumps in the road to success, if you want to be relatively free and profitable more consistently than not, then in order to do that, you must ensure that whenever you take a trade, it is in the direction of the 20-period moving average. Preferably in the direction of the 8 and 20, but certainly in the direction of the 20-period moving average. Meaning that if the daily bar of the market is green and the daily bar of the stock is green, and you are taking a trade on the 5-minute, you must make sure that that trade on the 5-minute has a rising 20-period moving average. Okay? You trade with the 20-period moving average. 20-period moving average is rising, you can take that trade long. If your daily bar of the market is green, right? The daily bar of your stock is green, but the 20-period moving average on your 5 is declining, maybe that's a pass. Trade with the flow of the 20. Does this make sense? Okay. Now, use the 8 and 20 as support and resistance points. The 8 and 20 are when they're rising, they will tend to form areas of support. They actually tend to halt micro moves to the downside. They stop them. So, if we get 55% retracements that are bouncing off of the 8 and 20, they are our best entry areas. Anytime you get a trigger at or near a rising 8 or 20, or anytime you get a trigger at or near a declining 8 or 20, it's going to be a more powerful trigger than a trigger away from those moving averages. When the 8 and 20 are rising, they tend to serve as a trampoline under the stock that buoys the stock back to the upside. When they're declining, they tend to act as an overhead ceiling, and they stop stocks from rallying when they're declining. Every time? Of course not. Most of the time, yes. And the steeper their ascent or descent, the greater their support or resistance capabilities. Steeply rising 8 or 20, powerful support underneath the stock. Steeply declining 8 or 20, powerful ceiling over the stock. Powerful ceiling above the stock. Is this clear? Okay. Now, the 20 is a median line during sideways consolidations. The 20-period moving average serves as a middle point. When the stock is moving sideways in a trendless environment, it will often crisscross the 20 back and forth. So it'll drop through the 20, below the 20, rally back above the 20, drop back below the 20, rally back above the 20. The 20, when it's lying on its back, when the 20 takes a nap, the stock will crisscross it back and forth like a child who's playing when their parent is not awake. And they go above the 20, back, they ignore the 20. The child is ignoring the 20. The stock is ignoring the 20. It's going back, crossing above, below, and he's saying, he. See, this 20 thinks it's strong. It's not strong. Look at it. I'm crossing above, I'm crossing below, I'm crossing above, I'm crossing below. But at a certain point, the 20 is going to wake up. And sometimes it will wake up as a bull, and sometimes the 20 will wake up as a bear. Now, here's how you determine what the next move is. One of those rallies above the 20, below the 20, above the 20, below the flat 20, above the flat 20, below the flat 20. At one point, one of those moves will get halted at the 20. Which move gets halted? Is it the attempt to go back above the 20, that the 20 stops it? Or is it the move down when the stock tries to get back below the 20 and the 20 says, wait a minute? So when the 20 stops the decline, it wakes up as a bull. The next move is up big. If it stops the rally from going through, it wakes up as a bear, and the next move is down. So the first halt, the first capture after multiple crisscrosses is your number one indication of what the next trend's going to be. Let me repeat this very carefully. It's very important, and I'll show you many pictures that demonstrate this as we move forward. If the stock is crisscrossing the 20, above the 20, below the 20, above the 20, below the 20, there will be a halt somewhere in the future. that 20 will wake up a bull or a bear. If one of the declines gets halted after there was multiple crisscrosses, if the 20 finally stops the stock from crossing back below it, it wakes up as a bull. The next trend is up. If it stops a rally from getting through after multiple crisscrosses, it wakes up as a bear. The next trend is down. And so I teach traders to identify that first halt, that first capture, that first stoppage by the 20 after multiple crisscrosses, because you have just grabbed the beginning of an enduring trend. Milk it for everything it's worth. All right, so I love to find stocks that are currently in a trendless environment, ignoring the 20, crisscrossing, because I know I'm in store to capture the beginning of a trend once a halt does occur. Oliver, every move above or below the 20 is a potential halt. No, it's not. A halt is a halt. A cross is not a halt, right? It's either going to cross it or it's not. Every move toward the 20 is a potential halt, yes. But if it keeps going, that's not a halt, that's a cross. If it doesn't keep going and it stops and then reverses, it's not a cross, it's a halt. Now, what event must happen at or near the 20 for you to determine that this is not a cross, it's a halt? What event must happen? There you go, Scott. Beautiful. A 55% retracement event at or near the 20, you've got your halts. Right? That's what a halt is. All right, we'll look at this. We will look at this. Now, the last guideline for the 8 and 20. When stocks get far away from the 20, the 20 starts to become a magnet, and it calls the stock back to it. Listen to me carefully. Stocks cannot stay far away from the 20 for long periods of time. They can get far away from the 20. They can't stay far away from the 20. So when a stock leaves the 20 far behind, the 20 yanks the stock back violently. All right? Now, the stock can get far behind on the below the 20, so the stock can drop way below the 20 and the 20 will pull it back up, or the stock can rally way above the 20 and the 20 pulls the stock back in. But if there becomes a wide separation between the stock and the 20, you're in store for a counter move all the way back to the 20. Stocks cannot remain far away from the 20 for a long period of time. They can get there, they can't stay there. Water seeks its own level. There's a natural regression all the way back to the mean. The 20 represents the mean. And so moves away from it will eventually get pulled right back to the mean, the 20. Moves away from it above get pulled back to it eventually. Moves away from it below get pulled back to the mean. You can get away from the mean. You can't stay away from the mean. Does this make sense? All right, now some of you have heard me use the example that I use to teach my children this concept, the dog concept. We have a dog, a boxer. His name is Dante. All right? Dante's a very strong, muscular boxer. And when he was little in particular, I had one of these retractable leashes. Now, sometimes if a squirrel was running across the street ahead of us, Dante would take off, boom, take off, and retractable leash would just start expanding, expanding, expanding. Dante left me behind. All right? But the leash eventually would run out, and then I would crank it back in and pull Dante back to me. All right? So he got away from the mean. I'd pull him back to me. Then sometimes Dante wanted to sniff a tree a little bit longer than I wanted to stay there. I would keep walking. Dante would stay. And all of a sudden, the leash starts expanding again. Because Dante's staying, I'm walking forward. He's getting further and further. I'm getting further and further ahead of him. He's getting further and further in back of me, away from the mean. When the leash would run out, I would pull him back in, and he'd come to me. So Dante can get a little bit ahead of me, but he'd come back. Dante can stay a little bit behind me, but he's always come back. I'm the mean. I'm the 20-period moving average. Stocks can get away, a little bit above, a little bit below. They can't stay there. They get pulled back to the mean. These extreme movements away from the 20 do create opportunities to play the snapback, which we talk about in more detail tomorrow. Okay, so guideline number 1, trade in the direction of the 20. Your life is going to be easier. I guarantee you that if you look at your losing trades, 80% of them or more are because you fought the 20-period moving average on the time frame you traded. I guarantee you. It's hard to lose money consistently playing with the 20-period moving average on the time frame you're taking your trade in. If you're taking your trade on the 2-minute, that 20 better be rising. You're taking your trade on the 5-minute, that 20 better be rising on that 5-minute. You're taking your trade on the 1-minute, that 20 better be rising on your 1-minute if you're going long. You're taking a short on the 5-minute, that 20 better be declining. You're taking a short on the 1-minute, that 20 on the 1-minute better be declining. Does this make dollars and cents? Does this make sense? That is true. Very true, Vince. Sometimes the mean does go, and we talk about that tomorrow as well. All right. Now, let me ask you a question. Let me see if you've got this concept down. Daily bar in your market is green. Daily bar in your stock is green. Okay? 5-minute chart, declining 20-period moving average. What do you do? Pass. Don't. Somebody says buy. You guys really scare me. Some of you guys scare me. Trade with the 20-period moving average. All right? It's okay. Okay, line them up. Line them up. Now, these are guidelines, guys. There are scenarios where it is okay, and I'm going to teach you those. The general guideline is trade with the 20 in the direction. If you're supposed to go long and that 20 is declining, pass most of the time. Okay, your life's going to be easier. 8 and 20 are beautiful areas to act on if you get an event. If a 55% retracement of a red bar happens at or near a rising 20, oh my goodness. Buy it if it's in sync with the daily chart. If 55% retracement of a green bar happens at or near a declining 8 or 20, by all means short it if it's in sync with the daily bar. They serve as beautiful areas of support and resistance when they're trending. When the 20 is flat, wait for the first capture, the first halt. That'll tell you where the next trend is. And if a stock gets way too far above or below the 20, you're in store for a violent snap back toward the mean. Dante has to come back. Right now, let's take a look here. Let's look at this daily chart. This daily chart shows a rising 20-period moving average. Okay? And during the 5-day course, we teach you how to build these charts and put the moving averages on and so forth and so on. All right? Now, notice how at or near the point of contact with the 20, you get a nice ricochet off the 20. Look at these. Boing, boing, boing. This looks like it's going to boing. The 20 as a rising moving average tends to serve as a nice firm area of support. Now, take a look at this bar. This bar looks as if it violated the 20-period moving average, but it didn't. I want you to imagine that the 20-period moving average is a rubber band, or it's a fence with a lot of play, a fence that the bulls and bears can lean on. But a lean against the fence is not a break of the fence. This bar is leaning against the fence. It's stretching the rubber band. It's not breaking the rubber band. This bar looks like it marginally broke the fence, but it did not break the 20-period moving average fence. It leaned on the fence. So the next question naturally is, well, Oliver, if just like the ropes of a boxing ring, if these are not breaks and they're just leans, what is a break? Well, I'm going to tell you that now. This is market law number 2. The market doesn't accomplish breaks of any kind with just one bar. One bar breaks are leans. 2 bar breaks are real breaks. It needs at least 2 bars to regard anything as being real. A break is not real unless it's a 2-bar break. A violation is not a violation unless it's a 2-bar violation. The market does not accomplish anything with just 1 bar. It needs 2 bars to make something real. 1 bar's a lean. 1 bar's a phony. 1 bar's a fake. 2 bars is the real thing. Now, here's what a true penetration is. In order for this bar, in order for this to be a penetration, you need the initial poke-through bar. This is the initial poke-through bar. Where the arrow's pointing to is the initial poke-through bar. That's criteria 1. Then you need a second bar. The second bar must break the low of the poke-through bar. Now you have a break. You need 2 bars, but the second bar must break the low of the poke-through bar. Does that make sense? Got it? Now we have a violation. You do not have to wait for the second bar to close. Once that second bar violates the low of the poke-through bar, your moving average is broken. But as it stands, this is not a violation. You only had one bar. There was no confirming second bar. There was no confirmation made. There was no follow-through accomplished. No follow-through, not real. Okay. Can it trigger your stop? Well, if you had a hard stop there, of course it can trigger your stop. We haven't talked about stops yet, though. Not in great detail. Guys, look. Notice if the 20-period moving average is rising, you will often get ricochets off the rising 20. The 20 will tend to halt declines. So, anytime you get a trigger, what's a trigger? A 55 or 100% retracement event. If that trigger happens anywhere around a rising 8 or 20, it's better. Those are going to be your best entries. So, if you look carefully at this circle, that's a 55, that's a 100% retracement of a red bar event right off the 20. Here's a 100% retracement of a red bar right off or near the 20. Here's a 100% retracement of a red bar right off the 20. Here's a 100% takeout of a neutral bar right off the 20. Okay? Now, I want to point something out here. Notice that to my left, the stock was under a flat 20. Then it moved over a flat 20. Then it moved marginally under a flat 20. Then it moved over, and then the 20 halted the next attempt to drop. This first halt, this first stoppage, this first capture is your sign that the next trend is now. We're going to get a nice enduring uptrend, and I'm going to get multiple halts at the 20 now. Let me milk them all. That's a debatable question, Robert. Right? Why is the 20 so reliable this way? All right? It's a debatable question. I will answer it later for you and give you why I believe it's powerful. All right? And that still probably won't fully answer the question, but give me a little bit of time and I promise I'll make it. Now, guys, look at this. Look. Notice the stock here is below the 20. Below the 20. Below the 20. Now we rise above the 20. Once I go from under the 20 to above the 20, I'm watching like a hawk that next decline. If that next decline cannot penetrate back through the 20, if the 20 wakes up and says, halt, who goes there? If the 20 stops another penetration and then gives me a 55 or 100% event, boom, I've just caught the first higher low in what should be a nice enduring uptrend. I caught the first one. Boom. Now, where's my entry here? At or near the 20, all I need is a 55% retracement of a regular red bar or a 100% retracement of a neutral bar? Which one did I get? Regular or neutral? I got the neutral, right? Yeah, because right under the number 3 here, that's bar number 4. No, that's bar number, I'd say that's bar number 11, right? I've got bar number 11 right at or near the 20, right? Is that bar number 11? And so bar number 11 says I need the high to be taken out before I act. The high was taken out, and my entry is on this green bar. Now, we pull back toward the 20 again, and I get a 55 or 100% retracement of a red bar again, right near the 20. Bam! Then I pull back to the 20 again, and I get a 55% retracement of a red bar again, right at or near the 20. Then I come back to the 20 again, I get a neutral 11 again. I need the high taken out. Bam! Right off the 20 again. All right? Trade with the 20 in the direction of the 20. Trade with in the direction of the daily bar. Also trade in the direction of the 20 on your micro time frame. And then look for entry events at or near the rising 8 or 20, and you're in business. Rising 20. Entry events at or near the rising 20. In the direction of the daily bar, you must be doing this, of course. Never forget that. Now look at this. Notice how, to my left, the stock is below the 20. Then it rises above the 20 at about 3:30, 15:30. Then the next decline cannot and does not penetrate the 20. The 20 wakes up from its nap and says, halt. Where do you think you're going? At or near the 20, after this halt, if you get an entry, what's an entry? A 55% retracement of a regular red bar or a 100% retracement of a little neutral bar. We've got little neutral bars here. Then a 100% takeout of a neutral bar right near the 20. Enter, stop. There's our money. Yes, ignore. You ignore everything but the 20 in these flat scenarios. Okay? Once the stock starts rallying and trending, then your 8 and rising 20 concepts come into play. But this is how you capture the first one. How do you capture the first entry before the trend really gets going? It's the first 20-period moving average halt. That's the first one. After that, you go into trending concepts. Right, the 20 is not going to be rising at your first halt. Do you understand that I'm growing your possibilities here? I'm giving you pieces. I'm giving you your opportunities in pieces. One opportunity is the first 20 MA halt. Another opportunity, once it gets going, is 55 or 100% retracements at or near the rising 8 or 20. But I'm also giving you a concept to capture the first one before the trend begins. All right? Sometimes you're able to capture the first one. That first one's not going to be, that's not a rising 20 concept. That's a grab the first low concept. Grab the trend right at the beginning concept. Once it starts going, now it's rising. But remember, if you're buying, even at a 20 MA halt, that daily bar had better be green. All right? That daily bar had better be green. Don't get these things mixed up. Look. Here the stock was under the 20. Then it finally gets above the 20. Okay? Then it pulls back. The 20 halts the stock. At or near the 20 says, halt. Where do you think you're going? And you get a 55, 100% retracement of the red bar right off the 20. This tells me that that move to the downside's over. We're now moving into an up mode. Now, let's assume, guys, that while this stock was dropping to the downside, all right, this is how the daily bar, when the stock was here, okay, when the stock was there, your daily bar, this is a 1 minute, your daily bar looked like this. Bar. At the point that this stock was at this low at 28.66, you switch to your daily bar and say, wow, okay, this is my daily bar. My daily bar is green, which means that I just have to wait for a buy opportunity. Now this same stock moves above the 20. Now that little micro move, it's only like 20 cents, right? Maybe less. That little micro move now has your daily bar looking like this. Just a little bit higher. Because it had a micro move up. Then it pulled back marginally back toward the 20 and halted. Now your daily bar dropped a tiny bit, almost imperceptible, back to the downside. Now your 55% trigger occurs right around, or 100% trigger occurs right around 28.75. Bam! That's your entry. You're entering on your next buy opportunity because the daily bar says only wait for a long. Okay? Don't think that a drop like this on a 1 minute means the daily is red. This drop, guys, is 25 cents. Look, 28.95 to 28.65. That's 30 cents. What if the stock's up $2? Do you understand? If the stock's up $2 and your 1 minute shows a 30-cent drop, is a 30-cent drop big enough to reverse a $2 gain? Do you follow what I'm saying? You don't follow what I'm saying. Who doesn't understand this? I want to hear from those who don't understand. The stock is up $2. It's rallied from 20 to 22. And then from 22, it backs off 30 cents. Now it's at 21.70. Instead of being up $2, it's up $1.70. That bar is still not green on the daily because it's dropped 30 cents. Do you follow that? That a 30-cent drop does not wipe away $2 of green? All right. So the daily bar is still green. That 30-cent drop can look like this on the 1 minute. This is 30 cents. Look at your cents here. It looks bearish on the 1, but that doesn't mean that this 30-cent drop from here to there is 30 cents. So at the high, it was like that on the daily. This is how it looks after a 30 cent. This is your daily at the high. Let's say the high is here. Now this is your daily. Now after a 30-cent drop, the daily bar looks like that. This tail represents 30 cents. Right? That's a 30-cent drop. When you go inside of that 30 cents on the 1 minute, it looks like this. But this bar says, wait for a buy. And where's your next buy? Your buy comes at the 20-period moving average halt. So remember, the daily chart tells you what side do you look for. I'm looking for a buy. I'm looking for a buy. I'm ignoring anything that says go short. I'm looking for a buy. All right? Now, you're capturing, this is at the end of the day, but you're capturing a 20-period moving average halt. The 20-period moving average halt is a separate concept with trend. The trend is different from a trending concept. This is a concept that will give you the ability to jump on board the change of a trend or the beginning of a trend early. The first 20 MA halt. All right, yes, let's assume that this was at, I don't know, 10.50 instead of 15.50. All right? I understand that this is at the end of the day, but I'm just using it as an example, okay? Let's not be too literal. I'm teaching you concepts here. Why didn't I go in at 15.51? When the second green bar. Have I mentioned any concept that you buy when a stock crosses a moving average? Have you heard that throughout any of the presentations so far? Right, so, I mean, let's stick with the concepts, right? Okay, don't bring your concepts into this, please. All right, your concepts, if they were working, you wouldn't be here. Moving average, crossing of moving average. I don't buy stocks just because they move above a moving average, and I don't short stocks just because they cross a moving average. That's that kindergarten approach to the market that everybody, that books talk about and all that stuff. Nobody makes money from that nonsense. Right? If it were that easy, buy when a stock crosses a moving average, we'd all be billionaires. It doesn't work that way. All right. Okay, here. Declining 20. Now, I want you to assume that your daily bar in the stock is red. Now, you're looking inside this daily bar on a 5-minute chart, and you see on the 5-minute chart of this bearish stock, you see a declining 20. Now, find moments to just get into the stock. You're going to look for moments at or near the 20 to enter. 55% retracements of regular size green bars. like here, or 100% retracements of little neutral bars, like here. And just get in the direction of that daily bar. If the daily bar shows a 55% retracement of a green bar, so it was solid green, now it's lost more than half of its green, should we wait a look to trade short? I would actually go to a better daily barred stock, James. Stick with the pure dailies. Use the 55s in your micro time frames. Does that make sense? Stick with the solid bars on your dailies. Use 55% retracement events on your micros. Leave the 55% daily bars alone.